everyone, I'm Jerry Davidsey, CEO of Presilium Private Wealth. Welcome to Financial Planning Fridays, our weekly video series on financial planning where we work to simplify wealth management decision-making for our clients so they can focus on what is most important to them. Today, in our 23rd episode, we wanted to discuss one of the key measures of risk that we use at Presilium for our clients in retirement or as they approach retirement. How many years of retirement spending dollars do you have as a cushion? Or said another way, how many years could we use just the income and bonds in your investment accounts before we would need to begin selling your stock positions to meet your retirement spending goals? Most often, investors associate risk with the ups and downs of the market. From our standpoint, we feel that if you have a properly diversified portfolio, that you face an even more pressing risk: inflation or longevity risk, the risk that you will outlive your money. At Presilium, we want to reduce this risk as much as possible for our clients. One of the biggest mistakes that we see with families who are not yet working with us is they have a portfolio that will not likely outpace inflation in an effort to reduce day-to-day volatility. This is how we think about your investments instead. We start by building out your cushion, or a portion of your investment allocation that we can use to meet your retirement spending needs that is much less affected by market volatility. This typically includes investments in short-term bonds and money market. From there, we allocate the remaining dollars to a diversified basket of exchange-traded stock funds. This does two things for our clients. First, it allows us to more comfortably weather the market volatility that we expect to see every 3 to 5 years. And second, and equally as important, this ensures that our clients' portfolios are allocated in a way to outpace inflation and grow for them over time. When we analyze historical returns, we find that the probability that stock indexes will be positive increases with the length of time that you hold them. So if your cushion allows you to hold on to your stock positions for 5, 10, or even 15 years without having to sell during market downturns, we can tell you the likelihood that your stock positions will have been positive during that stretch, as seen in this chart. As you can see, if you held the S&P 500 index for a long enough period of time, it has been positive 100% of all periods so far. This is how we calculate your cushion. First, we look at your annual retirement spending goal. Next, we subtract any income that you will receive regardless of market performance, like pensions, Social Security, and dividend income. For example, if you have a retirement spending goal of $200,000 per year and an investment portfolio worth $3 million, the calculation would look something like this. First, we subtract $50,000 for Social Security and $60,000 from expected annual dividends. This leaves us with $90,000 per year that we need to withdraw from somewhere in your portfolio each year. If you hold $1 million in bonds out of your $3 million portfolio, this would last for about 11 years before we'd have to begin using stock to meet your retirement income goal. In other words, your cushion is 11 years. Over all 11-year periods, the S&P 500 has been positive about 98% of the time. And the average return during these 11-year periods has been 9.2% per year. Because of this and the diversification of the portfolio, the risk that you are actually taking is quite small. It is incredibly important to know your cushion to help determine your overall investment mix of stocks and bonds. But it's even more important, knowing the number of years in your cushion can allow you to sleep at night when the market is volatile. Thank you, and we look forward to talking with you again soon.